Thank you, guys. Pleasure to be here. So there's been a lot of conversation around private debt to start this conference. I'll continue the trend. The reasons are pretty obvious. It's been a tough quarter for bonds and probably going to continue to be tough for bonds. So for all of you who have liabilities you're managing, return expectations, how you're going to manage that within a fixed income bucket is the biggest question in a long time, right? So there's been comments about the Fed, how they're going to manage inflation, concerns about geopolitical issues. I think one speaker said the Fed's in a tough position. They have to thread the needle. That's well said. You have the combination of true inflation that comes from the supply chain disruptions that started with COVID, bleeding into wages, which is the big thing economists fear. In the 60s and 70s, that was called wage price spiral inflation, which was what scared the bejesus out of everybody. And then the other thing that happened in the 70s was the oil embargoes, which the sanctions with Russia are kind of recreating or simulating. So it's a little bit of a perfect storm if you're a member of the Federal Reserve on exactly what to do, which is why you guys are probably all getting the inbounds on your phones about an inverted yield curve, which sends economists also into a tizzy about potential recession. So there's a lot going on. I'm going to talk about private credit from a global perspective. I'm the CIO of TriLink Global. We are a global private credit shop. We are in almost 40 different countries, in 5 different continents, and we've been doing this for over 10 years. And I think some of the comments from prior speakers around private credit generally will make this conversation a lot easier. I'll be able to reference those. For us, it's really about what's different outside the U.S. than what is in the U.S. I realize it's a topic not everyone covers, so happy to have this be very interactive. Any questions, don't feel like you need to wait to the end. If there's a question, raise your hand and we'll get right to it. Better to speak with one another than at each other. So with that, I'll get started. First of all, a little bit about my background. So I mentioned TriLink Global. We're a global private credit shop for over 10 years. We've deployed over $1.5 billion, which is actually a lot when you think about outside the U.S. The U.S. is both the broadest and the deepest market in the world. And so the average deal size in the U.S. is like 10 times bigger than it is in most other parts of the world, just to give you a sense of the scope. So $1.5 billion for us would be like $15 billion if you were a U.S. shop. My background is in global macro economics. Spent most of my career, 25 years, top down across all asset classes. But since joining TriLink, been bottom-up focused with private credit. So private credit, I'll hit a little bit of what some others did, but I don't want to be redundant. So I think there's a few things to keep in mind. First of all, as other speakers mentioned, in your portfolios, it should serve the exact same goal that private equity does as a complement to stocks. Private credit is the private equivalent to bonds. It's literally that simple. It's just that private credit hasn't been around. As one of the prior speakers said, it was kind of a niche little strategy that was in vogue for a couple of years and then it would be out of vogue again, unlike private equity, which was constantly the right thing to be in, at least some portion of your capital. I think private credit is here to stay. The market, as I'll talk about more in a minute, is currently dominated by the U.S., but as it sticks around longer and longer, it'll become more diversified, just like private equity has over the last several decades. From a strategies perspective, on the right column, it's really just about where you are in the capital stack. So if you're senior, that's usually referred to as direct lending. It's the safest, most secure position. Just under that is usually referred to as subordinated, meaning you're next in line. Then third is usually mezz. So mezzanine is in between sort of your typical debt and equity. It has characteristics of both. So you would expect higher returns for that higher risk. And then distressed and special situations are kind of code for the same thing. It means there's some hair on that deal, which is why people are in it, and you should expect to have commensurately higher returns for participating there. Private credit, generally speaking, why is it important? Again, the bond market's in a tough place, not just recently, but forward-looking. We are kind of coming to the end of the longest bull run, meaning lower interest rates, in the history of the asset class. So at some point you hit zero, or actually negative real rates, which is what we've been in for some time, and you can't get any lower, and there's only one direction to go. So it's a challenge for everyone in this room of how to manage that. Uncorrelated, and what that really just means is uncorrelated to the ups and downs. In the same way that private equity is uncorrelated to your stock prices, because you're only receiving those values once a quarter and they're not gyrating every day, private debt has the same issue. It's priced quarterly. You're not at the whim of whatever's happening in the S&P or what's happening in the ag index. It's really about the fundamental value of the loans themselves, just as private equity is the same about businesses. The income is consistent, as you would expect from any sort of debt type of strategy. Most of the yields we see in private credit, we see global, so we see across the spectrum, are at the low end of the range, or in the mid single digits, up to sort of high single digits, and even low double digits if you get into some of the riskier strategies. And then particularly if you're at the top of the capital stack, capital preservation is still really important. Our view is, if you're really going to be a bond surrogate and not just kind of the flavor of the month, you need to really value capital preservation, because everyone in this room has that fiduciary duty, and it can't just be a swing for the fences kind of thing, or else it'll never really grow and it won't do the jobs you guys need it to do. Okay, so let's talk a little bit about the landscape of private credit. Again, I'll try not to be redundant to the prior speakers. So over $1 trillion now. This data was pre-Quinn as of Q3 of last year. So it's over $1 trillion now. A ton of money has been raised recently, and a lot of dry powder on the sidelines. So more and more money is going into the asset class, but still dominated by the U.S. So the prior speakers you heard talking about it, they were almost entirely talking about the U.S. market. I'll be going a bit outside of it. A couple other things to note. In the recent fundraising, dominated by the biggest firms who are going into the biggest companies. So you're starting to get a real disconnect between the capital available to big firms versus smaller firms. Not unlike in equities between large buyout versus small growth. Same concept. This is just some more data to show that. So what you can see is the vast, vast majority of capital has been raised by those focused on larger companies. Even those players who call themselves middle market really are upper middle to corporate. If you looked at the AUM and where those assets actually went. And then the ones who call themselves lower middle market are really middle market, right? So why? The old expression is just as much work to do a $50 million deal as it is to do a $15 million deal. So if you have a lot of AUM and you've raised a lot of money, you want to put that to work, and the easiest way to do that is with larger deals. But really where all of the opportunity is in lower cap. Now let's talk a little bit about global. So this chart shows you demographics. Economists will tell you in the long run, demographics are everything. So if you just look at the growth of the population of the world over the last 60 years, almost all of it has been in what are called developing economies. So we're at about 7 billion, with advanced economies being about 1 billion of that 7, so 1/7. If you go back 50, 60 years, there was still only 1 billion in the advanced economies, but the total was just over 2 billion. Okay, so all of the growth has been outside of like the US and Western Europe, for example. What that means is it's opportunity at the end of the day. So McKinsey, the leading sort of global business consultant, has called this the greatest opportunity in the history of capitalism. Why? This chart. I mean, at the end of the day, it's just this chart. That many people need goods and services, and when you go up in 50 years 6x outside of places like the US, that's all of those people need goods and services. So if you're wondering why even bother looking outside the US, one is that's where the opportunity is. Two, as I just got done mentioning, all of the fundraising has been pretty much in the US. So you have the same, a lot of money chasing the same deals. Some more data around being outside the US. These things seem pretty obvious, but just to make the point, growth is just faster. Why? Well, they're playing catch-up is usually the reason. So, for example, it's harder to be at the front end of technological innovation. It's easier to copy someone else's technological innovation. So once you get to the front of the curve, the way the US and Western Europe are, that's where the hard work really is. The middle income countries, they're just sort of every time the US or Europe comes up with an idea, they go, that's a great idea, let me do it here. And they can just play catch up until such time as you're at the front of the line and then you have to innovate. So a lot of growth, most of it is outside the US. So some common misperceptions about markets. The number one that we hear all the time, and even I'm guilty of it sometimes, is confusing the words emerging markets with developing economies. They're not the same thing. So the term emerging markets was actually coined by the private investing arm of the World Bank, called the International Finance Corporation, when they were making a fund, actually, and they came up with the term emerging market. It was really meant to be the market itself, meaning the stock market at that time. It later also became known as the bond market. So when someone says emerging markets, technically speaking, practically speaking, what they mean is the stock and bond markets of those countries. Well, if you understand what are in those stock and bond markets, it makes sense that they would be volatile because there aren't that many companies in there. And they're all cap weighted. So everyone complains about how the big tech companies dominate the S&P 500 now. It's like that, but on steroids in the stock and bond markets of some of these other countries. You literally have 3, 4, maybe 5 names that are dominating the entire stock market. Well, if you have a whole stock market with a handful of names, don't be surprised if it whips around all over the place. That's pretty normal. Developing economy is more of where is the actual economy itself, the GDP, which is important for firms like us who are lending to private businesses. We don't care what the stock or bond market's doing. It's totally irrelevant. The only thing that matters is what is the environment like for those private businesses who are seeking capital, and you, like a bank, are seeking to underwrite that risk and lend money to them. Stock market up, stock market down is meaningless. Another big misconception, and it ties to the first one, is between risk and volatility. So if people are confusing an emerging market, meaning the stock and bond market, versus the economy, if that stock and bond market is very volatile, they will presume risk. Make sense? But that, again, that doesn't mean that that same level of volatility exists for private business. If you are a widget maker in Mexico, it's not that different from being a widget maker in the US. You have the currency, which I'll talk about in a second. But outside of that, it's really just about what? Taxes, bureaucracy, regulation. I mean, you still have employees to manage, you have input costs, you have the value add process, and you have your final goods, and you need to ship those goods and get financing for that whole process. It's literally no different. So again, that misperception that just because the stock and bond markets are volatile, that somehow connotates to risk when you're talking about the underlying real economy. Geopolitical. So this is the one that gets everyone's attention. And after I've been saying it's not a big deal for 10 years, Russia invades Ukraine. Fortunately, we're not in either Russia or Ukraine, and so hopefully people who you hire for your international investing know what they're doing. But for the most part, this has been a non-issue for us in these 10 years for a couple of reasons. Number one, it's really not rocket science. It's rocket science to know where to not be. It's not that complicated. It may seem like it, but you wouldn't have to study it very long to get a pretty good sense of where you want to avoid, whether it's for geopolitical reasons or whether it's for macroeconomic reasons. It's not that hard to come up with a list of places to avoid. Pretty easy. So that's number one. Number two, everyone believes that governments outside the U.S. just take over private companies all the time. It's called nationalization. It just doesn't happen. It's the Venezuelan situations of the world are few and far between, and Venezuela is on that short list of places that anyone could figure out to avoid. Right? So this fear of geopolitical risk, it really doesn't exist in practice. The one exception to that would be if you are either lending to the government itself, which I don't suggest you do, we don't, or lending to businesses whose biggest client is the government, which is very different than the U.S. Depending upon how you look at it, you could argue it's a bad thing, but in the U.S., being a government contractor is pretty good, right? If you're a taxpayer, that's not a good thing. If you're the business, it's a good thing. So, but that's the exact inverse of what we look for in our markets. If your number one client's the government, that's not something we're interested in underwriting. But other than that, geopolitical risk has been a non-issue. Currency risk, so this is the big one. And particularly in times of crisis, the dollar rallies, right? So it's the safe haven currency. So how do we manage that? Well, there's a couple ways. Number one, some funds or some managers raise money in the local currency, so then you don't have a currency mismatch. I'll use Mexico as the example. If you raise money in pesos and you deploy in pesos, it doesn't matter what happens with the peso. That's one way. If you are raising money in dollars or euros and you're going to deploy that into other countries, then it does matter. So how does one manage that? The way we do it is we only lend to businesses who are part of the global supply chain, meaning they are earning dollars, or if they're in Europe, euros. So they're not earning their local currency. How might that be? So the U.S. is still, the U.S. dollar, I should say, is still the global currency of choice, the reserve currency as it's called. And so transactions the world over are done in dollars. I'll give you an example. A client of ours who is a sustainable timber exporter is in Chile, South America. The biggest buyer of wood chips becomes paper is Japan per capita. The transaction between a Chilean sustainable timber farm who makes wood chips and a buyer in Japan, the currency of that transaction is US dollars, even though neither side of the trade is in the US. Why? Because both sides can trust it. The Japanese buyer might like it to be in yen, but the Chilean supplier is like, no yen for me, thank you. So therefore, it ends up being in dollars. The only real exception to that is in Europe, where everyone trusts and uses the euro. Other than that, it's really all in dollars. So that's how we deal with currency, but that is a substantive issue. And then the last thing I would say is fly-in investing. So in my career, this was a big deal. As this asset class becomes bigger and bigger, it should become a bigger deal for you guys as well. So the big firms like Goldman, Deutsche Bank, where I used to work, HSBC, where I used to work, the big global players, they want to have offices in London. London's sort of the global hub, the way New York is the U.S. hub. And they just want to fly over the world, come in, do a deal, leave some analysts there for a couple of weeks, fund it, and bounce. That's the way they work. Because again, it's just as much work to do a $50 million deal as it is a $15 million deal. So they don't want to actually put in the work to have people on the ground. That's a huge mistake in the long run, right? So if this asset class is going to become fundamental to everyone, it's just part of your allocation, you guys need to think about ensuring that the people you hire have agents on the ground. Just like you wouldn't do business in Texas if you didn't have anyone here in Texas. Imagine the same thing if it's a totally different continent, different language, different culture. You need to have people on the ground. They need to know their way around the local environment. It's not that complicated, you just need to do it. And there's some costs there, but other than that, it's pretty easy to do, but the path of least resistance is to be a flying investor, and I suggest you guys avoid it. Okay, so that's it for the, that's it for the presentation. Happy to take as many questions as there are. And since we're in 40 different countries, there could be 40 different questions. Yes? Did you? Oh, I'm sorry. Yeah.
So the opportunity set, non-U.S. developing economies, but property rights with a creditor is huge, right? I mean, so
it's a good question.
How do you reconcile that changing in property rights around the globe?
Yep. So the question was, as a lender, as opposed to say equity, your ability to enforce on collateral, if you have to, becomes really important. And so, how do you deal with that? And I kind of lumped that into the whole geopolitical risk that's been overstated in our example. But there are things you need to do. So, for example, in general, lenders like hard collateral, which is why you said property rights, because you assumed that I would take property as collateral, right? And we're no different than anyone else who likes hard assets. In some countries, hard assets are the right thing and a great thing. In other countries, you don't want hard assets. You want, say, their receivables. In other words, you want the cash. You control the cash accounts. Because as good as hard assets are, cash is even better, right? So it is important. What I would say is, in our experience, it's been much easier than feared. Including in countries where we haven't been hugely involved but have had some peripheral exposure, countries that have had issues that we wouldn't invest in. So for example, this is one of those countries you would avoid, okay? Argentina. 100 years ago, they were the 5th biggest economy on the planet. I think they're 5th biggest in their continent now. So they've had challenges. But they have a commercial court, a dedicated commercial court that bypasses the regular court, where if you have a promissory note, you walk up to the judge, you give him the promissory note, judge looks at it, says, "Is that your signature?" "Yes." "Have you paid?" "No." Boom, you lose. Way more efficient than here even, right? So for all the issues that Argentina has, enforcing on that promissory note is not one of the issues, right? So I would say enforcement is another one of those kind of boogeymen thing that you don't really see in practice. And if you go in knowing what kind of collateral you want and how to structure it, we have had no issues doing that. But that's something you want to know going in, how you'd like to enforce. Great question. Yes?
Can you compare underwriting covenants?
Yes, thank you for asking that question. That's a great question. So I mentioned before that, that all this money has come into the U.S., right? So there's over $1 trillion now in the asset class. The vast majority of that's in the U.S. And one of the prior speakers actually spoke about sponsored deals. And he went a little bit into what that means. So sponsored deals are where a private equity firm is the one who goes out and gets the loan for their underlying portfolio companies. Why is that good if you're the lender? Well, as the prior speaker said, more sophisticated counterparties helps. It also really helps origination, right? You don't have to go source a bunch of deals if the private equity shop just hands them to you, right? So that's helpful. The flip side is the private equity folks are pretty savvy, And you can be sure the fine print in those loan documents benefits them. In fact, that really came into play. There are a lot of articles on it, actually, when the pandemic first hit, where finally the U.S. private credit cycle kind of took a hit. And what ended up happening was when push came to shove and you needed to actually enforce, the private credit shops found out that the private equity firms had put all of the covenants in their benefit, and there were a couple of high-profile cases, Blackstone being one of them, where they just moved all the actual assets outside of that entity and dropped it into another one and left the lender with an empty shell. So yes, it's important to to appreciate the market itself, and when a lot of money goes into one place, then you get covenant light is the expression, right? So that means where the covenants are more for in the benefit of the borrower than they are for the lender, which is hugely important. In our markets, because the access to finance is so much lower, the gap in our markets, according to the World Bank, is over $5 trillion. Supply-demand mismatch, meaning there's 5 trillion more of credit deals that need to be done than there is money to do it. And that estimate was pre-COVID. And both sides of that equation have gotten worse. In other words, there's less money out there and there's more need. So by the time they refresh those numbers, I wouldn't be surprised if it was in the $7-8 trillion mark. So it just is a much different supply-demand situation outside the U.S. Yes, you have to get comfortable with being outside the U.S. in the first place, but once you get to that place, the fundamentals are just much better because there's less money chasing the same deals. Great question. So the question was, of that $5 trillion estimate from the World Bank, how much could you actually invest in? It's a great question, right? So whenever these big World Bank-like entities come up with these numbers, they're almost always an academic exercise by 100 PhDs, and who knows what actually is real, right, from that. So the way I look at it is this. Let's say that estimate's off by 10x, okay? Which would be big off, even for academics, right? That would take you from 5 trillion to 500 billion, right? And let's say you could only invest in 10% of that. So now you're taking that big number by 100x, right? So now you're at 50 billion. I mean, the total sort of cap space there is sub 10 billion now, right? So you could grow the kind of this niche of the asset class easy 5 to 10x before that question, which is a great theoretical question, is even remotely applicable. Other questions? I've got 1 minute and 20 seconds. Yes?
So, that being said, you mentioned there was a lot of dry powder out there too, definitely in the U.S.
All the dry powders in the U.S.
What is the time frame of deploying that?
We've been very fast, again, because the supply-demand is totally different. So for us, we have fully deployed like first closes in 90 days. But that's because we constantly have pipeline moving, right? If you went from a dead stop, meaning you weren't underwriting anything, and then all of a sudden you got a big commitment and you needed to deploy it, probably double that, call it 6 months. But hopefully you're not going from a dead stop. Questions? Yes?
What's the correlation to traditional U.S. credit?
Great question. Correlation between global private credit versus U.S., it should basically be zero unless you have something like the pandemic, which affected everyone, right? So everyone had a demand shock globally. Now you had some variances on how some countries handled it versus others, but it was still a demand shock to everybody. So that would give you some correlation. But for the most part, that should be it. for example, everyone always asks me about interest rates, and of course they mean U.S. interest rates, and I'm happy to answer that question, but the real answer is it has nothing to do with what's going on in our markets. Thank you. With that, I'm exactly at the time. Thank you guys, appreciate it.